And welcome back to all of our market rebels and options traders out there on YouTube. And Stu, kind of a wild week, man. We had Fed, we were up, we were down, popped up this morning, gave it all back at the close. So another wild market, huh?
I don't know what we're going to do about this. I'm kind of running out of energy, but every new day is a new piece of energy. So bring it on.
Bring it on. But it's always more volatility. And that's part of what we want to help you with, is to show you not the basics of strategies. We feel you can learn that stuff anywhere. We want to show you how professional traders think, how they adjust to the cards that they're dealt. I often use that as an analogy, like with a professional poker player. You're dealt some cards. What do you do with them? Yeah, your strategy might be working or had worked for the past few days, but what if it turns? How do you play day by day? How do you handle the volatility? And those are the insights that we like to show you here. And so let's take a look at Coach's Corner for today. And before we do, we're going to do something a little...
Volatility is where we actually make money, folks.
You have to have
without any volatility, the options game wouldn't exist.
Yep. So a little different. I have to show the disclaimers here. We have a little different tech platform going on today, but let me show you that one. And intellectual property rights notice, disclaimer number 2. And that brings us up to Chalk Talk. So for anybody who's new, Chalk Talk, we like to start off our program with a little huddle over here with the coaches and give you an intriguing question, something to think about, and then we're going to answer it at the end of the show here. So here's the setup, Stu. We've got the stock trading at $200. And the question for our traders, which is riskier? You can sell the 195-200 vertical put spread, or if you sell the 170 naked put. Now, somebody might be thinking, what's a naked put? Naked put is when you have no other hedge against it. You've got no short shares. You've got no long puts. It's just a naked put by itself, giving you the obligation to buy at 170. So that's the question to think about.
And I feel like this is a little bit of a trick question, Bill. Can I assume a fairly low volatility, 20, 25 implied volatility on this
That's actually a good question. It doesn't matter. You can assume whatever volatility you want. We're going to talk about that, but it's I will give people a little tip about that. It's typically going to be a tricky question, make you think. So I want you to jot down your answer. We like for people to commit to it because that's the way that you can really check to see if you learned something, and that's what we're here to do. And so for today, the risk of risk. And one of the ways that Stu and I come up with these topics is whether it's through Q&A or day-to-day conversations, things that's going on in the markets, but they're the problems that we hear people encountering all the time. Things that Stu gets as a coach and saying, here's another person that just didn't understand this or who made this mistake. Yeah. And that's how we come up with a lot of these topics. And so what are we talking about here? The risk of risk means that, yes, there's risk when you step into a trade, and there's a certain amount of parameters that we check that we might assess. But risk is not only risky, meaning it's uncertain, but it can change. The uncertainty can change. It's dynamic. And so that's a risk of risk. And so based on just a very small change in something, such as our little goldfish friend jumping out of the bowl, very small change can greatly magnify the risks. And that little change might be a very small change in the stock's price. It could be time going by, it could be volatility, a number of things. And people, or at least we have found, most traders don't consider that. They just look.
And that goes both ways. Could go.
Oh, sure.
It might increase. It might actually vastly decrease that risk, and there could be action that's required on that side of it as well.
And you need to know what you're going to do in all of those cases. Now, once again, once you initiate the trade, that might not matter. Doesn't really matter what you think. Remember, the markets don't care what you think. Markets are going to do what the markets are going to do. How do you respond? And so really the whole lesson we're trying to show you here is to make you more aware that just because you've placed a trade that you think has a certain risk parameters that you want, doesn't mean that's how it's going to stay. And that's a super important concept to learn. So the first thing is separating past and future. We have found that most traders have a very difficult time separating the past from what might happen in the future. And you have to remember that risk lies before the fact. There is no risk after the fact. It's now known. Remember what risk is. It's the uncertainty. So you might say, oh man, ABC stock gap down 10 points. That's no longer a risk. It's now 100% known. And that's why if that happens, all of the extrinsic value or most of it comes out of an option, let's say for an earnings play. It's now known. So the outcome today wasn't known in the past, and the outcome tomorrow isn't known today. And so another little thing to remember is that questioning your decisions after the fact, sometimes what we call Monday morning quarterbacking, it's easy to do because the outcome's known. And we find so many traders that do this. Oh, my covered call went in the money. I should have done that. Bad decision. You will always be kicking yourself because it's never going to work out perfectly. And the way that you make it work out perfectly, or at least to the best of your abilities, is to have a better perspective. And how do we change as things change? So always remember that undesirable outcomes must be dealt with before the fact. We were just talking about this today. There is no repair button or magic let me get my money back button.
No,
as we talked about last week, it's just an overlay. Sure, you could put on a new trade, but it doesn't erase what was already done. So that's what we're going to talk about. This is really important. Oh, it's so super important.
Can you put that back one, Bill, that slide? Undesirable outcomes must be dealt with before the fact. This might be the epitome of risk management. Yep. Right there. Anybody who is trying to engage themselves in anything resembling proper protocol for risk management is going to think about all the things they don't want to think about, all the things that can happen that even on a big, giant distribution curve, third standard, fourth standard deviation, they're thinking about them. They may choose to take that risk and they're prepared for that outcome, which however bad it might be, but they at least know what it is. And that's their decision. That's their decision to make. And it should be your decision to make before it happens, not after it happens. Because after it happens, it's history. It's gone.
That's right. There is no risk after the fact. You need to deal with that before when we don't know. And so assess those trades, look at those risk graphs, the expiration and the current, and say, well, what if? What if the stock goes from 100 down to 80? Don't tell yourself that's very unlikely. We already knew that. But what if it did? Is that going to cause a situation?
Or 30 or 20?
Just what if?
Think of worst case scenarios.
Are those going to be situations that are going to cause extreme problems? And if so, deal with them now. If you try to deal with it, go buy insurance when the house is on fire, you're going to find out why you don't want to deal with them then. So some other perspectives.
Broker.
So remember that there are known knowns. There are things that we know. We know that an option's extrinsic value goes to zero at expiration. We know that a call option will typically rise as the stock price rises. Those are things that we know, and those aren't really risks, which is why we usually don't consider theta a risk. It's a known. There are known unknowns. There are things that we know could occur. We don't know what they are. We know that the stock price could move, but where's it going to move to? I don't know. But it's not a surprise when we see that a stock price moves. Those are the known unknowns. But then there are the unknown unknowns. And these are the things that you really have to think about. They're the things that we don't even know. They maybe have never even happened, but this is why you have to always ask, what if?
This is the question that people ask themselves, or at least proclaim to me and to Bill and to the other coaches as well. Is I don't really know what I don't know. Right? I hear this a lot. I know enough to be dangerous, but I also know enough to know what I don't to realize that there's a bunch of things out there that I don't know, but I don't even know what they are. And that's what these unknowns are.
You have to think just what if. And so what this sets up here is that because of this, traders prefer quantifiable risks. They like things that they can say, for example, a vertical spread, which we'll talk about here in a moment. And they'll say, okay, because I know that I've got a limited risk, limited reward. But they don't realize that those risks are going to change as lots of things change.
Very dynamic.
They're not realizing that they're just looking at a bird's eye view of it at one point in time, and they think they have therefore quantified the risk, and that is absolutely not true. So let's take a look at a few examples.
Oh, hold on, time out. So what they did was they quantified the risk at that moment in time. at that
Correct.
snapshot. What people just don't generally think about is, well, what happens when the stock price changes, the implied volatility changes, days go by, interest rates change. How does that picture change at that point? That snapshot in time it's behind you. It's gone. It's history. It's
gone.
yesterday.
Long
What
gone.
does it look like today?
Right now. It's a very different perspective. So let's take a look at an example. Let's say that we buy a 100, 105 vertical for $1.75. And we look on our broker's platform and it says that it has a delta of 0.25. Remember that that's going to be the combined between
Net
those
delta.
two options. Long delta
One's
on the
long,
100,
one's short.
short delta on the 105. We combine them, we've got a delta of 25. We look, we got a gamma of 0.01. But the thing is, okay, people look at that and they go, oh, I've got a maximum loss of $1.75. I can make $3.25. Well, all right, so what? What's that going to be as time passes? That might be a
That's
good
only the
question.
beginning.
This is just, we're just showing you, this is just scratching the surface. This is one thing we're going
That's
to
the beginning
consider.
of the show. Yeah.
So let's go have a look. And as always, before we do, let's, for anybody who's new and wants to take their education to the next level, please check out marketrebellion.com/get started. Lots of great PDFs and files you can download, information, videos that you can watch that will help you to get started. Because remember, it's always about the education. It's not about predicting. It's how you're going to deal with things as things change. So
It's how
here we
you
go.
learn what the unknowns are.
Or exactly.
Right.
So here's what our risk graph looks like in black. This is the expiration graph. Let's say
This is
30
the
days
vertical
out.
spread.
We've got our bend at 100. That's our long 100. There's the short 105. The blue curve is what's called the current curve. It's showing us our risk graph right now. So as time goes by, though, watch what happens. We're going to remember that our stock is here at 100, and we had a delta of 0.25 or 25. That just means that right now it's behaving like 25 shares of stock.
One
But
spread.
again, it's right now, not 10 minutes from now. It's going to change. So watch what happens.
tomorrow.
As time goes by, that blue curve starts to do this. The left side is shifting lower. We're assuming the stock price doesn't change. And the right side is shifting higher. And what do we see now? Look at that. Our stock's still at 100. The delta's gone to 0. It was at 0.25, but it's now 0. But what if the stock goes to 100.01? It goes up 1 penny. Now what happens? People would say, I don't really have much of a delta, or I had 25 delta. Well, but it changed in 1 second, or in one instance, it went to 0. But if we increase by 1 penny, what happens now? Now it's delta 1.
Of course, this is
one.
an extreme, and this is accepting, over expiration and all that. But this is what you can wind up with. You got to
can.
think about, well, what am I coming in with on Monday after my in the money call gets exercised, even though it was a penny, and you're long 100 shares of stock at 100, and hello, it opens at 90 on Monday morning, and you're calling up your coach saying, "What do I do about it?"
What's the repair strategy here again?
Yeah, right.
So also notice over on the left-hand side, we have negative theta. That's why those curves over here, these colored curves, move down. But we have positive gamma. And that's because they have kind of a smile function to them. It just shows that they're going to generate deltas as the stock price rises. But only for a certain point. Remember, risks change. Once we cross this crossover point, we're going to reach an area where we have positive theta and then negative gamma. The positive theta means that these colored lines are getting closer to the black line, appreciating, but they look a little bit like a frown. We are starting to subtract deltas as the stock price rises. So it's the same strategy, and even though you looked at your risk on the black curve when you initiated it, that is far from what's happening while you're in it. Those risks are going to change.
And you could even say that point, that like kind of crossover point on that theta going from negative theta to positive theta and the gamma flipping on that vertical 100, 105 spread, you could, it's not exactly linear, but you could say that it's going to be somewhere around the 102.5 level, where once the stock moves past that midpoint, now you're closer to the 105 line, which is short. That's going to be a negative gamma position, and you're going to be collecting theta on a negative gamma position.
Correct. And that's very different. People don't think about that.
Mhm.
They say, well, I bought this spread. Well, yeah, you bought it, but it could behave like a short spread if the stock moves to a certain level. Things can flip on you and do very weird things. Now, because of this, one of the things that I like to do is maybe do it when the stock is in the money, or both options are in the money. So if the stock is at 107,
That's a
now look what
beautiful thing.
happens. Now I've got a maximum gain of $1.50. Maximum gain's not as hot, but look what happens down here. Okay, there's our max loss of 350, but I've got a long way for that to go. It's a relatively lower risk. I can actually even afford to have the stock fall from 107 to 105 and still make the maximum gain. I've got positive theta. I've got negative gamma. This is not really so much a bullish strategy. I call it not bearish because I don't need it to rise. If it rises, it's okay. But what my real hope is that it doesn't fall. You see the difference? It's a subtle difference, but it's a really important one. This is really more of an outlook of not bearish. And
Think
hey,
about think about you having a vertical spread on here and asking yourself, why am I thinking it's not good if the stock goes through my 105 strike?
Yeah.
This is showing you, and the math is proving it, that you absolutely want it to go through that 105 strike.
Absolutely.
And that's giving you a higher
Uh-oh, think we might have just lost Stu. Okay. What he was saying is it gives you a higher probability of collecting this $1.50. So it's maybe like owning a I'm not just looking at the black curve. I'm considering how things are going to change. So as always, please check out marketrebellion.com/get started. Let's take another look. Do we have Stu back yet? No, I think we lost him. Let's take a look at a second example, stock plus put. Let's say that you buy 100 shares of stock, you got 100 deltas, and you've got an at-the-money $100 put that has negative 50 deltas. And so you buy 2 of these puts, so you say, I'm trying to get a full hedge. I'm long 100 deltas, and I'm short 100 deltas, so now I've got a full insurance policy. Possibly. You do right now, but that's going to change. And so the question is, did you limit your downside risk? So in black are your 100 shares of stock, and in red is your stock plus 2 puts, at least the way that you think it looks. And we did this example because we hear this from traders. Well, I bought 2 puts, so I'm fully hedged. This is what they think is happening. But what actually happened? As the stock falls down, we start generating more negative deltas. We've actually gone from a hedged position to a speculative position. Who would have thought? We put it on with the intent of being conservative, and it absolutely flipped a 180 on you and became speculative because now you're pursuing profits in the face of risk. You are taking more risk in exchange for bigger profits. Well, that's not what you thought when you put the trade on, but that's how it changed. And so again, that's really the mantra we're trying to show for this presentation. Just because you put it on at a certain moment in time with a certain intention doesn't mean that it stays that way. And you need to understand, how is it going to change as time, volatility, stock prices change at a minimum? How are these risk graphs going to change? And if they do, how are you going to contend with it if it's an unwanted risk? Let's look at another one, diagonal spread. Let's say you buy a 120-day $80 call, stock's at 100, and you sell the 30-day 105 call. So it's 5 points out of the money. Net debit of, let's say, $22. This is mostly because we're so deep in the money. The stock is 100. This has 2 points of extrinsic value, our $80 call. So it's bullish. We're buying the lower strike call, more valuable, selling a higher strike. But just prior to expiration, let's say the stock is 104.99, and so you don't close. Why should we do it? Why should we spend the commission? Because it's an out-of-the-money option. Well, At expiration of the short, let's say that the stock closes at 105.01 or higher. So something changed. The stock moves up 2 cents on you. Not a big change, but what did it do for our risk graph? Well, because you thought it was going to close at 104.99, here's what you were thinking happens to your risk graph. You were going to go from here to here. Right? If we look at yesterday's, you had that short position, it flattened you off, it expires worthless, at least that's what you thought, and it does this. And you're going, oh boy, on Monday morning, I'm going to have this unlimited upside. I've been chipping away at this long option for so long, and hey, look, the futures are up. Everything's great on Monday morning. But because it closed in the money, you got assigned, you sold stock that you don't own, you're not on this black curve, you're on this one. Exactly opposite of what you thought, because the stock moved 2 cents. And again, it's people just don't realize that it can take a very small change in something to cause a 180-degree opposite outlook. And so here's another really good example. So just remember that risk isn't about the probability of losing. You must understand how those risks change over time across different stock prices and across different volatilities. And there are risks of risks. That's what you have to understand. So I hope that gives you some things to think about. It looks like we definitely lost Stu. So let me go ahead and cover our chalk talk. So remember what the situation was. We have the stock at 200. The question is, which is riskier? One trader sells the 195-200 vertical put spread, and another sells the 170 naked put. Now, the reason I put this question in here, most people would say, hey, we all know that naked puts are riskier. Well, again, it depends. It's a hard question to answer. But people look at things in terms of absolutes. They like the quantifiable risks. So they say, oh, if I sell the 195-200 vertical spread, I know my risks. I'm not 100% sure with the naked put, so therefore the naked put is riskier. Not necessarily. And here's why. Here's the probability. I think I used a 30% volatility, but it doesn't even matter. Stu even mentioned that at the first, when we first looked at this question. What are the volatilities? It doesn't matter. The point is that the stock falls to 195 or below. That's when the vertical spread becomes maximum loss. And the chances for that to happen are in the red. But what about the short put? Chances for that to happen are down here. I did that so it'd be exactly at the 2 standard deviation mark. Can it happen? Of course it can happen. It's just not as likely. Now here's where we draw the distinction. Yes, in total, a naked put has more uncertainty around it, but it's a conditional probability. This is riskier if the stock hits 170 or below. Then we've got problems, but that wasn't the question. The question is, which one is riskier? Which one is more likely to happen? You're more likely to lose on that vertical spread, even though most people think, hey, I quantified my risk and therefore I have almost no risk. You actually had quite a bit. And not only that, you had risk if the stock price changes, volatility changes, and time changes, and you didn't even know. So that's what we're trying to make people see. All right. So just because you put this trade on doesn't mean that it was without risk. You've got these bends here. We have to say, what's the probability that we hit these? And so that's really the main message that we wanted to get across to people, to understand that there are certain risks when you enter a position, but that it doesn't matter what it is unless it's a T-bill. And actually, even that's not true. T-bill risk will change as interest rates change between now and maturity. There's always a risk, and those risks will change over time because of stock price, theta, time moving, and also your volatilities. And if you're not aware of how they're going to change, you're going to find very quickly that there are risks of risks. So we just wanted to pass it along, give you some things to think about. We hope that helped, and I hope we get Stu back on next week. I don't know what happened to him, but that's all that I have for you today. I want to thank you for being here again. I hope you picked up some good tips, and we'll look for you next Thursday, 4 p.m. on Coach's Corner.